It is the holiday season. You know how you can tell that? If you're checking us out on our YouTube channel, you'll know that I am wearing a Christmas tie. One of the things you need to be aware of this holiday season is make sure that the Grinch, for the purposes of this show, the Grinch being an annuity or an insurance company, doesn't ruin your Christmas. We'll talk about that on the program. Plus, some of the unaccounted factors when it comes to projecting your income in retirement and the importance of putting some of those factors into the mix, especially if you're relying on one of those online calculators that at the end of the day, the assumptions behind them, according to studies, only fit about 4% of the population. So we're going to be talking to the other 96% of the population about some of those factors that you need to account for when you're planning your retirement income. Welcome to the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris, Certified Financial Planner, Certified Financial Fiduciary at Nelson Financial Planning, where our team of Certified Financial Fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. So 2 weeks to go before Christmas. This year, Christmas falls on a Sunday, which means that if you're playing along at home, next week we will do the usual show. I'm going to be joined by fellow certified financial fiduciary and also fellow certified financial planner. It became official this past week. And also CPA Kristen Cayley of our office. We're going to be talking about some of those tax things that you can do prior to year end. There's still time. So she'll be joining us on next week's episode. And then the following episode that actually falls on Christmas Day. So once every 7 years we encounter this. I think we typically run like some holiday songs, some Christmas songs, right? Would be appropriate rather than talking about money on Christmas Day, right? So anyway, that's what the next 2 weeks look like. And then the third week, Sunday falls on January the 1st, if I'm getting my calendar right. That, of course, is our fearless forecast. Every year, our tongue-in-cheek annual forecast of where we expect the markets to go for the year 2023. We'll also recap what we expected for this year, and I think we're a little off this year. But we've had a pretty good track record over the course of the past several years. We'll recap all of that 3 weeks from today. So anyway, I hope you're having a great holiday season at the office. We are finishing up our toy and food drives, which end this coming Friday. The toy drive obviously benefits Toys for Tots in its 75th year of collecting toys for children. I was talking with a friend and client this past week as they were dropping off some toys, and hard to believe, 75 years for that great organization. And then also collecting food for Second Harvest Food Bank of Central Florida. So obviously, we want to take a moment and thank all of the folks who participated in both of those drives. Still have an opportunity to do it anytime between now and 4 o'clock on Friday. Around the office, if you've been to the office, you know that this time of year, we always like to kind of get into the holiday spirit, put some lights up, not only inside, but also outside. This year, we added, and you can have a particular philosophy of this. My wife and I have this debate. She thinks it's a little over the top. We decided that at the office it would be perfectly fine. We got a 10-foot snowman, one of those blow-up things. So anyway, come by, check it out. Looks particularly cool in the evening, which these days starts much earlier because I guess it's the shortest day of the year coming up, right? So, and then that time will start to go the other way. So, but anyway, hope your holiday season is going well. Certainly, we are enjoying it. One kid home yesterday one kid home today. The other kid comes home, I think Friday is the potential date. So anyway, we're looking forward to having the house full again. As if you've ever gone through that empty nesting phase, you know it kind of a little quiet in the first few months of that, like Stephanie and I have experienced this past fall. So anyway, last week on the program, we talked a little bit about the Dow now being in bull market territory, which simply means that it meets the technical definition of that, which is that it has risen 20% from its previous low point. And you might not have necessarily seen that because there's been a lot of distractions this fall in terms of other headlines. But the reality is that the Dow has been on some pretty decent performance. Obviously, since for the past week or so, some of the stories about inflation and potentially higher interest rates have chipped away at that rise, but at the start of this month of December, it had crossed that threshold. And so we talked about that a little bit on the program, and we thought it would be good to spend a little bit more time on that today to kind of expand on that a little bit. And the reason it's important is that when we think about performance of the major market indexes, and that's the Dow, the S&P 500, and the NASDAQ, the Dow actually is having its single best outperformance relative to the S&P 500 since 1933. So some pretty interesting spread, if you will, that's happening depending upon which part of the market that you're looking at this year. So we thought we would sort of reset some of the conversation to just sort of chat through why things are happening in that particular fashion this year more than any other. We'll reset the conversation with an explanation of what those indexes are all about, right? So the Dow is 30 companies. The S&P 500 represents a weighting or an average of about 500 different companies, and then the NASDAQ about 3,700 companies. So you can kind of see where the Dow pretty concentrated because only looking at 30 companies versus the S&P 500, as the name suggests, that's 500. The NASDAQ would be about 3,700. Those are the three primary indexes that people kind of look at or that the media kind of flashes up on the screen when you're looking at that. At the start of December, the Dow was down about 5% since the beginning of the year. S&P 500, which is generally viewed as sort of that broader market indicator, was down about 15%, and the NASDAQ was down about 27%. As we mentioned, that sort of 10% differential, if you're down 5 versus being down 15, well, then you're performing better. That differential, the largest, as we've said, since 1933. So what's the explanation? Because that's a pretty big difference between those three different indexes. Well, there's always a reason that exists when we start talking about those different indexes that causes their relative performance to always be a little skewed, because 2 out of the 3 use a market cap weighted average, that would be the S&P 500 and the NASDAQ, versus the Dow, which uses a price weighted kind of differential. So that's a key component or a key differential between how those indexes are calculated. We're going to take a break. When we come back from the break, we're going to talk a little bit more about that and what that means, along with highlighting the key differential that might be driving that big spread between the different market averages, particularly this year. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking about the Dow's relative outperformance being the greatest since 1933 versus the S&P 500, and discussing how that is happening, particularly this year with that big of a spread. At the beginning of December, Dow's down about 5%, S&P 500 down about 500, NASDAQ down about 27. So that's a pretty big differential between those three major market indexes. And so we thought it warranted a fuller conversation on the program to just sort of walk people through why that difference. Now, there's always a classic difference that exists between those indexes. The Dow is 30 companies, the S&P 500, 500 companies, NASDAQ about 3,700. So right there's a big differential in terms of the number of companies associated with each of those major market indexes. But there's a traditional difference that exists between all of those market indexes, and also sort of a one that is unique to this year. The traditional differential is simply how they are calculated. So the S&P 500 and the NASDAQ are based upon market capitalization of the particular companies that are involved. So what that means is that if you are a bigger company, you're going to have a greater contribution, a greater weight to the overall performance of those particular indexes. Particularly over the past few years, think technology, the FANGs, if you will. At one point, over the course of the trailing 5-year period that was sort of at the start of this year, so if you go back, start of this year and then back 5 years, those 5 or 6 major technology companies, Facebook, Amazon, Netflix, Google, Apple, TOS, and Microsoft, were driving almost a third of the performance of the S&P 500. So that's what happens when you are market weighted or market cap weighted, is that you can have a handful of companies, big giant ones, that's for sure, that really start to skew the performance of that particular index. The Dow, on the other hand, is price weighted. You take all the different stock prices of the 30 companies in the Dow, you add it up, you divide by a factor that accounts for things like stock splits and the like. And so a higher share price company is going to have more of an impact than size or market value. So that's just fundamentally always a difference between the different market indexes and what always exists as sort of a different way that each of them sort of calculate. But it certainly doesn't explain this greatest performance in almost 90 years of the Dow relative to the S&P 500, because usually those sort of track a little bit more closely. And that has to go to the uniqueness that is this year, right? I mean, obviously, the aggressive increasing in interest rates by the Federal Reserve has really been a major impact on those more technology companies, because higher interest rates typically affect a technology company or a growth company, because those companies attract investors on the expectation that they're going to have excessive growth in the future because they've got a unique product or a unique service or a unique good that ultimately is going to create a huge amount of revenue in the future. In order to get there, typically they borrow money. And when they're borrowing money, then that means that interest rates matter, or access to easy capital certainly matters. And so that's a big driver of what is happening. And it is, as you might imagine, those technology companies has a disproportionate impact on the upward performance of the S&P 500 and NASDAQ over the course of the past 5 years prior to the beginning of this year. Now it's sort of working in reverse, right? A disproportionate impact in the negative direction as a result of those higher interest rates. On the flip side, the Dow, on the other hand, companies like McDonald's or Coca-Cola, Walmart, Disney, Home Depot, higher interest rates don't necessarily have a big impact on them, right? You're still going to buy a soda. You're still going to go get some, hammer and nails at Home Depot, things like that. So not as dependent, if you will, on money and borrowing money and things like that. So that certainly is a pretty significant differential, particularly this year, that explains sort of that outperformance of the Dow relative to the S&P 500. Again, as we've said, the largest outperformance on a relative basis since 1933. The problem is, and here's the takeaway for investors, if you will, and there's two things to consider. Unfortunately, a lot of dollar flows are sort of missing this. So if you look at where investors are putting money in, and you look at funds and ETFs and things like that that track the S&P 500, through October of this year, net inflows into those types of funds was about $71 billion. If you take a look at the other side, the funds and ETFs that sort of track the Dow, total inflow was about $2 billion. So unfortunately, a lot of investors are still sort of fixating on what worked yesterday in terms of investing their money. So bottom line, we think the takeaway for investors is to make sure that you are checking your investment allocation, particularly when we go through a tough year like this one. You want to make sure that you are positioned in such a way as to be more balanced than perhaps what you were, because a lot of times performance can skew sort of that balance and cause you to forget certain types of companies. Value companies, or those traditional companies that just sort of make the stuff that the world uses every day, may not be as exciting as a Facebook or a Netflix or a Google, but at the end of the day, you're still buying that stuff no matter the economic conditions. And that particular concept is really playing out during the course of this year. So make sure that you take a moment and look at not just the amount of your investments that are in large companies versus small companies, or U.S. companies versus international companies, but really take a look at that difference between, okay, well, how much do I have in growth, and which is mostly technology, and how much do I have in value, which is mostly considered dividends. So some key takeaways, particularly as it relates to the relative performance of the Dow versus the S&P 500, and frankly, investors still loading up on funds that generally track the S&P 500 at a pretty dramatic clip. So those are certainly some things to be thinking about. Welcome to the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on a host of stations throughout the Central Florida region. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out on your podcast channel of choice or on YouTube as well. Have any trouble finding our channels on any of those platforms? Well, just go to our website, Nelson Financial Planning. Upper right-hand corner, you'll see a bunch of icons. Click on the one that looks most familiar, and you'll get instantly connected to our particular channel. My name, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So we talked about this at the top of the show. It's holiday season, but we're seeing more and more where the Grinch, otherwise known as an annuity company or an insurance company, or the folks that push said products, are stealing people's Christmas, so to speak. What do we mean by that? What do we mean by that? Well, let's step back and take a look at the types of things that you might hear in today's world. You hear the ads, right? You get all the upside of the market with none of the downside whatsoever. Now, that would be great if it was true, but if that was really true, then you'd kind of have to suspend your common sense, right? Because what company in America is going to offer you that deal? Because we all know that you can't predict the future, right? So that would require them to be successfully predicting the future in order really to offer that. So what's really going on behind that? Well, stay tuned through the break, and we will illuminate you more on the story behind the Grinch that might take your Christmas if you're not careful. Here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So we've all heard the ads. You get all the upside of the market with none of the downside risks, right? Well, be careful, because you don't want the Grinch taking your Christmas away, just as you don't want an annuity or an insurance company or the person that sells that stuff to take that away either, because the reality is there's a lot of fine print on those products. We've certainly talked about that in previous radio shows before, but as is usually the case, when you have a year where the market does not coordinate or behave like we like it to, the sales of those products go up dramatically. And so what you've got to realize is that you can't suspend basic common sense believing that you're truly going to get all the upside of the market with none of the downside risk. I mean, stop and think about that, right? I mean, you don't actually believe that, do you? Because who would do that? You can't predict the future. An insurance company's not going to just all of a sudden roll out that kind of product without something else going on behind that. The reality is there's a lot of fine print on them. That's why when you get involved in one of them, you get a booklet about yay thick. For those of you who are looking at YouTube, you know, like it's like a half an inch thick. So for the radio, it's a half an inch thick. That's a lot of fine print in there that ultimately chips away at that overarching statement that you hear a lot of times on various media. So we're going to break down some of the fine print, if you will, on how that works. And then, most importantly, we're going to give you some question to ask anytime you are confronted with that choice that I doubt you'll ever get a straight answer to. And then lastly, give you a couple of examples to really drive the point home very clearly. Because the reality of this is that liquidity and access to your money is always important because two things are going to happen. First of all, there's going to be changes in your life. Second of all, there's going to be changes in the economy and the interest rate and inflation environment. We're seeing it play out right now. So here we go. Welcome to the program, of course. This is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. It's Central Florida's longest-running radio program, coming to you on a host of stations throughout the Central Florida region. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out on your favorite podcast channel of choice. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. So what are some of the fine prints on these products that make the claim that you're going to get all the upside of the market with none of the downside risk? Well, first of all, don't suspend your common sense believing that, because it doesn't happen that way because of these factors. Number one, things like participation rates. You don't get all the upside in the market. You just get some of it. Number two, they eliminate the dividends. And if you know anything about the market, over the course of the past 80-odd years, dividends have contributed almost half of the performance of the market over that 80-year period of time, 44% to be exact. So if you're measuring and then you take out the thing that like accounts for like half the performance, well, then you get the idea, right? You're not actually getting all the upside of the market. Oftentimes these products have spreads or margin fees, things like that. Another way that they do it is by capping the amount that you're actually going to get. And so constantly, because of all of this fine print, don't count the dividends, cap it out here, calculate it this way, add it this way, average it this way, all kinds of sort of math tricks, if you will, that the insurance company does in these products, you wind up with not nearly the kind of return that you think that you were going to get in the first place, particularly over time. And I guess that gets us to the other thing is you're going to be required to hold this product over a long period of time because at the end of the day, that's how the insurance company wins this, right? They don't win this by simply offering you this particular transaction. And while you still have full access and full liquidity and full ability to use your money in whatever form and fashion you want. They've got a way to make sure that they do that. How? Because they want to make sure that they have that money over time. Because they have that money over time, then ultimately they will be able to come out ahead. How do they do that? Well, that's the most important piece of the equation, and it's those long and large surrender charges. There's no real options for liquidity. Oh, yeah, they'll say, oh, you can get 10%, you get 15%. Yeah, okay, fine. I'm not completely shut off from being able to access my capital, but what if the interest rate environment changes? What if inflation changes? What if my life changes and I need that capital? Because the reality is, I don't think I've ever met anybody who truly understands what they were getting, truly understands and appreciates what the underlying fees are, truly understands and appreciates how the product actually works, and at the end of the day, didn't wind up in some form or fashion regretting it, but at the end of the day, no way to get out of it because it would cost them so much money that they were basically stuck. But here's the most important thing. And the reality is that this is the key concept. If all of this other stuff hasn't made sense to you, here's the bottom line. The amount of compensation that these products pay is just outrageous. They're the highest commission product in the business. Pay a tremendous amount of money up front. And so we challenge you. If you're confronted with that as a proposition, as a recommendation, if you will, go ahead and ask next time. How much is that person getting paid? How much is that firm that they work for getting paid? You won't get a straight answer. Never been anybody that I've been doing in this biz for a long time. We see these products, unfortunately, all too often, and we ask the question, did they ever tell you how much they were actually getting paid? No, they said it was all taken care of by the insurance company. Out of the goodness of the insurance company's heart? I mean, is that what it is? Let me be very clear, okay? Anybody that says it's taken care of by somebody else, at the end of the day, you're paying it. That's not, you're not having altruistic insurance companies that are paying massive commissions on these products thinking that they're just being nice because, they're just nice. No, doesn't work that way. The reality is that there's a huge, anywhere from 7 or 8%. So stop and think about that. You do a couple $100,000 into that. It's a $16,000 commission at one shot on the transaction. Doesn't that sound a little excessive? Doesn't that sound a little extreme? Particularly if they're locking your money up for 8, 10, sometimes even 15 years? Seems dramatic, right? Reality is you're never going to get a straight answer from it. By comparison, ours is on our website, nelsonfinancialplanning.com. Fully disclosed, talks exactly about how we get paid and compensated along the way. At most, it winds up being about 1% per year based upon the value of your account. In contrast, if you're looking at some of these products, massive amounts of compensation that are getting paid that no one ever fully discloses to the investor. Why? Because a normal person would walk away if they ever heard the number. Never going to get a straight answer, but go ahead and ask. See if you get a straight answer on it. To the dollar. Quantify it. Not percentage, not, this, that, or the other thing. To the dollar. How much are you getting? Period. The reality is that if you knew, you'd fall out of your chair and walk out the other way. That is for sure. So we thought we would. The reality is if you don't know how much someone is precisely making by recommending a particular course of action to you, then perhaps you should not take that particular course of action, period. We'll leave you with 2 examples, 2 stories that we've seen just this month. And it highlights the limitations with taking this particular approach. So number 1 has to do with the changed environment, right? I mean, we are in a changed environment in terms of inflation and interest rates. So in this particular case, the individual put $200,000 into a fixed annuity 2 years ago and was told, you're going to make 2% per year for the next 5 years. Now, of course, they're looking at other options, right? Because 2% doesn't work. And so consequently, particularly versus a high yield savings account at, say, 4%. So that's the difference on that. We're going to take a break. When we come back, we're going to hit these 2 examples, and then we will segue through to our next topic here on Dollars and Cents with Joel Garris of Nelson Financial Planning. On the program today, we're having a tough conversation for folks that have had the Grinch steal their Christmas. By the Grinch, we mean an annuity or insurance company or a person that sold you the product, and you realize, this doesn't really work the way that I thought it did. And by the way, they never actually told me how much exactly they were making when they put me in the product. I assure you it was a ton of money. It's the highest commission product in the industry. So hopefully you didn't just do that recently because, then they just had a very Merry Christmas on you based upon the amount of compensation that they made off of you by going into that product. We'll give you 2 real-life examples that highlight why these products are not what they are cracked up to be. The reality is life changes and the current economic climate changes as well. So the first example we were talking about before the break is someone who invested in a fixed annuity 2 years ago and had at an interest rate of 2%. At the time, hey, that's great, okay? But now, looking around, high yield savings account, yeah, you make about 4% on those now. And so they're thinking, well, wait a minute, I'm only making 2 now. I'm locked in on that. I'm locked in on that for like another 2.5 years. Why don't I mean, I'd like to get over to this 4% stuff and make double my money. Problem is, as we mentioned, it was a 5-year annuity, and you're only 2.5 years in. Guess what happens if they decide to do something differently? They lose all of the interest that they made in the first 2.5 years. So you're kind of stuck, right? And that's the point. At the end of the day, the environment can change. Interest rate environment, inflation environment can change much faster than you and I can possibly even imagine. And if you don't have the ability to access your money and make a different decision without a significant cost like that, basically 3%, 4% of the underlying principal is, I mean, it's all gone. The profit's all gone when you're trying to make a different decision on that. Then it underscores why liquidity is so important. It gives you the ability to change things should something in your life change or something in the overall environment change. Here's the second example, and this one is way more egregious than that first example. And so this one really should trouble you on a lot of different levels. And this deals with the fact that they just fail to deliver on the promises that are made. So 2 years ago, this particular individual put $850,000 into one of these products. Commission paid on that, by best guess, probably about $60,000. Stop and think about that. $60,000 on that particular recommendation. That is a tremendous amount of money that's getting paid based upon the recommendation to put you in that particular product. 2 years ago, okay, money goes in one of those equity index, market linked, all the upside of the market, none of the downside risk nonsense types of products. Okay, so last year, 2021, he's looking at it and saying, well, there was an up year in the market and I didn't really make anything. And then you uncover the participation rates, the caps, the elimination of dividends in terms of measuring the indexes, things like that, right? So at the end of the day, he starts to kind of look more and more into the fine print, starts to look at other options. Problem is, he then discovers the extent of the surrender charge. So $850,000. 2 years later, if he decides to do something differently, he's going to wind up getting $760,000. That's right, a $90,000 surrender charge to do something different. Stop and listen to that number. $90,000 is what it's going to cost him to do something different. If that doesn't shock you, if that doesn't turn your stomach, only people who come out ahead on these products is the insurance company that markets and sells them and the people that recommend them. It's just a terrible, terrible product. It's a terrible investment. It's predicated upon fear. It's predicated upon, oh, the world's going to end. And look, bottom line, okay, if you really want that, then it's called your bank, and it's called a savings account, and it's called a CD, and it's called an FDIC guarantee. That's what it's called. Do that. Don't fall for anything else thinking that you're going to somehow make a better return than what you can get for the path that you are picking for your investments. If you're picking a path for your investments that says guarantee is most important, I don't want to lose principal, it's not this nonsense. Because the second you want to have any flexibility, the second you want to have any liquidity, well then guess what? You don't get it. You're jammed up and you won't be able to have any of that in any way, shape, or form. So be careful. Buyer beware, particularly when it comes to these types of products. Okay, let's shift gears, because those are pretty tough examples when you start to kind of work through those with folks, particularly folks that are, trying to retire, trying to generate out income, and facing longevity, facing a completely different interest rate environment, a completely different inflation environment, and life changes. and the economy changes and the environment changes, and you want to be able to adjust accordingly and not be stuck. So anyway, speaking of things you need to think about, man, we might be running out of time on this one again this week. We're going to try and, in this last few minutes, kind of hit as much of this as we can before we kind of have to wrap up the program for this week. But some factors that you need to consider when it comes to figuring out your retirement income. So a couple weeks ago, we started this conversation on the program. We hit a couple of the biggies. Obviously, chief among them is your health, which then directly affects your longevity, right? If you're 60 years of age and in excellent health, you got a pretty good shot at making it to 90. Similarly, depending upon your retirement timing, that, of course, is going to determine a lot of what you wind up having to take in terms of income, whether you're going to retire at 62 or 65 or 67 or 70. And the point of this conversation is that a lot of the online calculators out there today don't really sort of address some of the uniqueness of the factors. As we said at the beginning of the program, based upon the assumptions that these online calculators typically make, they only apply to about 4% of the population that sort of assume good health, assume that you don't want to leave any money behind, that you're going to claim Social Security as soon as you retire. That's really only about 4% of the population. For the other 96%, these are the factors you need to consider. And it sort of underscores this notion that each and every individual is unique when it comes to planning for retirement, and not just planning for retirement, but more specifically, trying to figure out where you're going to get your income in retirement. Because there is a big difference between reality and expectations in terms of the timing of when you're going to retire. According to a study, about 10% of those age 62 to 64 expected to retire. The reality is, in that age group, nearly about a third of folks that age retire. So the difference between reality and expectation. We're going to table this one again to next week. I can't believe that. I think that's the first time I've ever kind of tabled something for a third week, but we will do that and continue the conversation next week about this particular topic. That's about all for this week's episode of Dollars and Cents with Joel Garris of Nelson Financial Planning. If you like what you heard and want to learn more, visit our website, nelsonfinancialplanning.com, or just pick up the phone and call the office this week, 407-629-6477. Have a great rest of the holiday season.